To determine which ETF is the best investment between TQQ and QQQ, it is essential to understand what each of these exchange-traded funds represents and their underlying strategies. The QQQ is an ETF that tracks the Nasdaq 100 index, which includes the 100 largest and most actively traded non-financial stocks listed on the Nasdaq. On the other hand, the TQQ is a leveraged ETF that aims to provide 3 times the daily return of the Nasdaq 100 index. The primary difference between these two ETFs is their investment objective and risk level. The QQQ is a standard ETF that provides direct exposure to the Nasdaq 100 index, making it suitable for long-term investors seeking broad technology sector exposure. In contrast, the TQQ is a more aggressive and volatile ETF due to its leveraged nature, making it more suitable for short-term traders or investors with a high risk tolerance. When deciding between TQQ and QQQ, investors should consider their investment goals, risk tolerance, and time horizon. For those seeking long-term growth with lower volatility, the QQQ may be the more appropriate choice. However, for investors looking to capitalize on short-term market movements and are willing to assume higher risk, the TQQ could be a more suitable option. It is crucial to remember that leveraged ETFs like TQQ are designed to achieve their stated objectives on a daily basis, which means their returns over longer periods may not necessarily match their stated multiples. As a result, these ETFs are generally not recommended for buy and hold strategies. Ultimately, the choice between TQQ and QQQ depends on an individual's investment strategy and risk appetite. Investors should carefully evaluate their financial goals, assess the risks associated with each ETF, and consider consulting with a financial advisor before making an investment decision. By doing so, investors can make informed choices that align with their overall investment objectives and risk tolerance.